Good evening, everyone. Hopefully your Friday was good, and hopefully you had a good work week. Let's get right into it because I don't know if I have enough space or storage left to get this video off. But here we go. Please like and subscribe and comment. Please share this with a friend. I appreciate the support and help. Thank you guys so much. All right. So, is home rates coming down finally? Not home rates, I'm sorry, interest rates based on President Trump, his speech he gave at the World Economic Forum, and he said, "I want interest rates to come down. They should have been came down, and we're going to work to get those down." And a lot of people in the industry and real estate ears perked up, myself included, and for a lot of us younger, and I guess it's not really an age thing, but let's just say if you're newer on the investor side, you bought your house or investment property in 2021, that was, when interest rates were all-time low, just after COVID. I think we were at 3% or below. Some people were getting like 2s. Why don't you comment in the comments, and if you do own property and like that, what was your interest rate? Just curiosity. So I got a 3% interest rate, which is fantastic. But like I always explain in real estate, I bought a property looking to do value add. For those of you who don't know, or you're new to the channel, or you're new to real estate, value add just means you buy a property that just has a lot of deferred maintenance, meaning like it's a capital heavy project. So it's got to come in, with your hammers and start taking it apart and putting it back together. So anyway, if you were in that camp like myself, this was definitely good news, because this would be our first round of being able to extract some of that liquidity, doing like cash out refinance, which is the beauty of real estate. Once you're able to do a cash out refinance, it's like collecting a little harvest, and then still having that property continue on producing positive cash flow. So now you've done a liquid event, and you could take that capital and deploy it into more property and assets elsewhere, and so on and so on. A lot of us who bought in 21, investors, small, I'm talking specifically to the smaller investors. Maybe it was your first property that you purchased in 21, like myself. I purchased a property and did a bunch of work to it, but by the time I was done with the work, interest rates kind of just shot up, and it didn't make sense to cash out refinance. It just was like I was going to end up paying double. The equity may have been there. Actually, the equity wasn't quite there as yet, but if interest rates come down even to 5, then it's going to make sense for me. What I would encourage everyone to do, especially if you're an investor, is you need to run your numbers and know your numbers. And here's how I look at it. When I look at my numbers, I look at what my property, what debt I owe on the property, and then what I think the property will sell for on the high end. Let's go to the absolute highest end. And if you know your market very well, you should know those numbers. And then I say, okay, my debt minus what the property's worth, and then whatever's left, I look at that and I'm like, okay, bank will lend me 70% loan to equity, loan to value on that. And then you can look at interest rates. You get a mortgage calculator there on Google, just Google one, plug your numbers in, and then see what that monthly payment would be after you run it through the mortgage calculator, because the mortgage calculator will plug in your insurance number, tax number, all that stuff, and will produce you like a monthly payment. And that just gives you kind of a ballpark figure. You should run that at the high end, the medium end, and the low end, right? Just so you know you're prepared. Okay, if my appraisal doesn't come back hitting my high end, I've ran the numbers at the middle ground level, and I should still be able to make something happen. And the lowest thing, you got to know what your bottom dollar is, because you expect to at least hit that. The simplest way I would recommend is going on Zillow, Redfin, looking at what your property could sell for today, if you can sell it, and then do some research and comps in the area, and then kind of go, build up from there. My recommendation is what I'm doing. I am just sitting in the ready, waiting to go. You never want to do too much of a refinance where you start to go negative though. So meaning if you're pulling out so much liquid or so much equity and the asset, you affect your monthly cash flow, not a good deal. You don't want to get into a trap where you pull too much equity out and now you've created an alligator. We don't do alligators. That is a big no-no. So you want to pull it out where it's comfortable. You still have some buffer there for cash flow and you can stay the course, still owning the asset, and you go from there. One other thing I wanted to talk about, and we'll see, I'm trying to just get this in real quick. Everyone needs to study the economic or the credible threat theory. Okay? I don't think I'm going to make it here. The credible threat theory basically talks about how you have to, it was an essay actually, rather. It was an essay of an economist. Everyone just go to follow Simon, the uneducated economist. He has a great channel, talks about the credible threat theory. And basically it just says that back in 2019, the Federal Reserve, I forget who the chairman was, but he had a speech and basically said they're at the end of the line of what they can do financially as far as predict the markets, or not predict, but manipulate them. And all they have left is their speech. So it's not so much if they're lowering or raising interest rates. Obviously, we all want that. It's more about what they're saying. So when Trump gets up there and saying, like, I expect interest rates to do this, do this, do this, it's kind of like a sign that, okay, let me cast that net out there, and if my words carry any weight, let's see if the markets will adjust accordingly, right? It's the idea of, how can I put it? It's like they're trying to test the market, right? Because they can't really get to a neutral rate. That 2%, that's just a fictitious number. They can't really achieve that because they have a couple mandates, right? Employment and stable economy. Like, those are the two things that they're mandated to do. At this point in time, it's hard to balance both of those things with the state of our inflation rate and all that sort of stuff. So the credible threat theory just talks about using your words to basically scare people. That's why when you hear multiple headlines, more news anchors, everyone talking about recession, 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 it's kind of like self-fulfilling prophecy. Then you get into a recession. Like, people act accordingly. So that's why they talk about a credible threat theory. So anyways, I say all that to say it's all going as planned, if you will. Like, they're not stupid. They know what they're doing. But what you need to do is know your numbers and then wait. And then as soon as you are able to, if those interest rates come down to a level where you can go ahead and hit the go button, just go for it. Okay? I know that was a little convoluted at the end. Hopefully, that was somewhat helpful. But the main thing is, this isn't bad. We're just kind of waiting and see. So it's kind of a holding pattern, which is kind of what most people expected. So, but still good to hear at least it talked about. Hopefully this is helpful. Please like, subscribe for more content like this. Take care. Bye.